Many people who are saving for retirement, especially those in their early accumulation years, don't have enough to max out every single retirement savings account opportunity that they have. So they have to make choices about which to fund first, like 401ks, Roth 401k, Roth IRA, regular IRA. And some of you have access to a pretty snazzy little account called an HSA. If you're not familiar with the details of an HSA, you're in the right place. I'm Amy Buck. I'm owner of PlanPath Financial, and you found me on my YouTube channel, Retirement Planning 411. When it comes to deciding what retirement savings accounts you'll contribute to and what level of contribution you'll do in each one of those, that's a very individual decision that depends on your own financial circumstances. So the discussion today is simply general discussion. It is not necessarily advice for any particular person. Make sure that you talk to your own financial advisor or financial planner who understands your financial situation. But in general, if I have a client come to me who is trying to save for retirement and they work with an employer who offers an HSA plan, and of course you have to have a high deductible health plan in order to qualify for an HSA account. But when they have that opportunity and they have a 401k or a 403b, I always have them start with that to the extent that they get the match from their employer. So if their employer is offering a 3% match if they put in 6, my recommendation is for them to put in the 6% so they don't leave that 3% of free money on the table. If they can get 4%, if they put in 4%, they're going to put in the 4%. But at that point, we're not going to put any more into the 401k until we get that HSA account fully funded. And I'm going to explain to you why I believe the HSA is probably the most valuable retirement account, even though it's actually a health savings account. What an HSA account is an account that was developed to help those who are in a high deductible plan offset that high deductible with a savings account that they could use to pay for medical expenses. And any distributions that come out of that HSA account go to pay those qualified medical expenses tax-free. But there's more to it. There's a reason why many of us in the financial world call the HSA the trifecta of savings plan. But there's one more thing that I'm going to share at the end of the video that I don't want you to miss. So make sure you stick around because it's even more than a trifecta. It's like a trifecta with a cherry on top. So what I mean by a trifecta is an HSA account, similarly to your 401k, for instance, or an IRA. When you make contributions into those accounts, they go in pre-tax. So you're not making contributions that have already been taxed. That money goes in before any tax comes out of your paycheck into 401k, other than FICA taxes. Payroll taxes are deducted. An HSA account, those contributions are also made through your payroll. And those contributions also go into the HSA account pre-tax, but they are fully pre-tax. Your employer doesn't even take FICA tax out of HSA contributions. So 100% tax-free going in, just like the 401ks and the IRAs. They accumulate growth inside those accounts, tax deferred. And then unlike a 401k, where when you take distributions out and you have to pay tax at that point, when you take distributions, like I said, out of your HSA account for qualified medical expenses, they are also tax-free. Not taxed going in, not taxed while they're growing, and they are not taxed when they come out of the HSA account if they are paying for qualified medical expenses. For the calendar year 2024, the annual limitation on deductions, or in other words, how much you could contribute into that HSA tax-free, is $4,150 if you are an individual with self-only coverage. If you're an individual who opts for the family coverage, you have a wife, kids, it doesn't matter how many, then your limitation is $8,300. So often the question comes up, what if my wife is covered under my plan, the health plan I have through work? Can she based on that plan, open up her own HSA account? And the answer is yes, she can. However, the limitation overall between the two accounts is still the same. It would still be the $8,300. If she had her own HSA account through her own employer, then she could have her own individual contribution amount as well. From my experience working with clients, many of them see this HSA account is simply a reimbursement account for medical expenses that can be paid tax-free. They don't see it as an investment account, and that couldn't be farther from the truth. Now, while it's true that many of the custodians that employers have managing the funds that are in those HSA accounts have some pretty substandard, I guess I would say, investment options, especially if you're trying to reach for growth within those accounts. You can check with your employer because many of them, most of them, are going to allow you to take the money that's in those HSA accounts and roll it over into a different HSA account with a custodian who does offer lots of investment options. One custodian I know of that does that is Fidelity, for instance. If you roll that money into a Fidelity HSA, you can invest that into ETFs, mutual funds, etc. So why is that important? Well, like I said, I want you to think of the HSA account as more than just a medical reimbursement account. And I understand that you may need it to reimburse yourself for some of the medical expenses that have come up if you do run into them. A lot of people don't have many medical expenses, so you may have money just sitting there. You might as well put it to work for you by moving that money over into an account where you can invest it well. What will often happen as well is that people decide on a certain contribution level from each paycheck to go into their HSA. And then by the end of the year, toward the end of the year, they realize they're not fully funding their HSA through those payroll deductions and they want to top it off. If you've been in the plan the entire year and you qualify for the full deduction or the full contribution level, then what you can do is just write a check into your HSA account to that custodian on your own. So for instance, if you've rolled it over to a Fidelity account, you can just pay into that account whatever that gap is between what you've put in through your employer and what you're allowed to put in for that tax year. Just make sure you don't go over that level or you could be penalized for that. The money that you pay into your HSA on your own out of your own checking account that will have had income tax and FICA tax already deducted from those funds. But once you put that money into the HSA account, while you're not going to get the FICA tax money back, you will get the deduction on your tax return for the amount that you put in. And those deductions do not have to be itemized deductions. Those are what we call above the line deductions. And if you're not sure what I mean by that, I'm going to put a link into this video that explains the income tax rules and how an income tax return works. And it explains what those above the line deductions are. But overall, what it means is that it's going to reduce your gross income before taxes even get worked into it. So it's a deduction that you can take even if you're not somebody that itemizes, and then you're still going to get the standard deduction below the line. It's important to note that before you turn the age of 65, if you were to use or take distributions out of your HSA account that are not for qualified medical expenses, you would have a 20% penalty for those withdrawals. So you want to avoid those withdrawals prior to the age 65. But here's the cherry on top. Once you turn age 65, this HSA account, for all intents and purposes, becomes another 401k or IRA from a distribution standpoint. Because once you turn age 65, there is no penalty for taking distributions for any reason. If you take a distribution that is not for a qualified medical expense after the age of 65, you would simply pay tax on that money just like you would from any other pre-tax retirement account. If your distribution after age 65 is for qualified medical expenses, it still comes out tax-free. So this little HSA account that you've been saving up to pay for medical expenses, which you may end up wanting for medical expenses, especially as you get older, and maybe there's a gap in insurance coverage or you have more medical expenses than you've had. But if you don't have those medical expenses to pay for, you have a nice little additional retirement savings account. One last note, is that when you do reach age 65, if you haven't retired yet, when you do get to the point that you're going to apply for Medicare, keep in mind that there is a 6-month look back. You cannot contribute to an HSA while you are on Medicare. So you want to make sure that those two things do not overlap. And the government's going to look back 6 months to see whether or not you've been making contributions into an HSA during that time. So that is an HSA in a nutshell. If you have one at work, make sure you go check it out. And if it makes sense for you, then make it part of your retirement planning strategy. Want to learn more about retirement and tax planning strategies? Check out more videos on my YouTube channel, Retirement Planning 411. I also invite you to head on over to Facebook and join my discussion group, which is also called Retirement Planning 411. You can be a part of the discussion about retirement and tax planning. You can ask questions, and I post lots of educational material in that group as well. Come on over and join us. And if you would, hit subscribe to my YouTube channel. Thanks.